All right, guys, welcome back to the channel. Today, I wanted to go over a scenario that came in. We ultimately didn't end up financing it. The borrower said they went with another lender, but I wanted to kind of walk through the thought process because when it was initially presented to me, I raised additional questions. And maybe that scared off the investor. I don't know, but I want to walk you through the math and the thought process so that when you're looking at your own scenarios, you can kind of run through what we run through when we kind of scrutinize the deal to make sure it's a good loan that we can lend on. First, the tool in front of you is just a tool we've created for free. It's called buyandholdcalculator.com. Now, the scenario that was presented to us was it was presented as a fix and hold. They wanted high leverage financing on the front end, and then they were going to, inevitably refinance it and use it as a short-term rental, which in and of itself is a good strategy. It's a way to put less money down when the numbers support the deal. So if you go to buyandholdcalculator.com, it's free for you to use. I'll put a link in the comments, and you should be doing this type of underwriting when you're looking at scenarios yourself. So I've already put the numbers in just so you can kind of see. So $660 on the purchase, $30K rehab, ARV 750. Now, a lot of times we'll go up to 75 ARV. That's usually that's basically the market cap is 75 ARV. So we'll punch that in. I'm gonna have to do the math. What is 75? Maybe it is. Let's see. I'm doing this in real time, so you guys can kind of see the process here. 75, maybe I already had it in 75, ARV of 750 is 562.5. Okay, so that'll be the loan amount that we underwrite for this. Typical loan terms, 12% interest, interest only loan, $5,000 at closing costs. Maybe it's more, maybe it's less. I don't know. We didn't get that far. 1 point, and assume a 6-month hold time in this loan, meaning not that they're going to hold the property for 6 months, but this short-term rehab debt is going to be a 6-month term. Maybe it's this investor is an experienced investor, so I'm not poo-pooing on their deal at all. I'm just maybe it was 3. It doesn't really matter for the purposes of this. The illustration of what I want to talk about is down below. So with those loan terms, they're going to be putting 127.5 down, which isn't ideal at these numbers. $10,000 in closing costs, total investment. So this is total cash in the deal, 166,750. Now, if they were to exit this loan, they'd make a 12% return on their money, over the course of the whole time, which we said initially was 6 months. So again, I changed that and some numbers changed. That's okay. So on the front end, not super profitable. 8% ROI. A lot of flippers when they're flipping properties to sell them, they like to see 20 to 30% returns. You can obviously change the ROI by reducing the hold time, which in turn reduces the reduces the holding costs. But we'll just say 6 for get in the deal, get the rehab done, get it refinanced, whatever. Okay. So refinance details. So I'm gonna give the investor the benefit of the doubt and give them kind of best case scenario numbers. So 80% refi, which there are a few lenders out there. We are one of them. There are a few lenders out there that'll do an 80% refinance on a short-term rental, but you got to have experience doing it. Otherwise, you're generally capped at 75%. That's okay, whatever. We didn't get this far in the conversation, but I'm going to assume for the purposes of this, they're going to be making $6,000 on a short-term rental. It was down in Florida, near Orlando, so you got that Disney money coming in. And then these numbers, I don't know how far off they are. It doesn't really matter. For the purposes of this illustration, I would bet there's an HOA, but again, I'm giving benefit of the doubt for the illustration here, 7% interest rate, 30-year term. So this is where it gets weird for me, and this is why I ask questions. So at the end of the day, they're going to still have $134,000 left in the deal. Now, the burn method, the whole philosophy behind the burn method is to pull your money out so you can go do it again. So there's 2 things I asked on this, right? I was like, what's the long-term goal here? And, what are you looking for as far as financing? Because these numbers tell me, this individual is going to have to hold this property for 90 months to break even on their investment. All the cash they put into the deal, they're going to have to wait 90 months which is 7.5 years to just break even on the investment. That's okay if that's your strategy. I was inquiring about it because to me, when I look at this, I go, maybe I'm missing something when I look at this deal because I'm not seeing it. So when I ask a few questions, I just want to understand the investor's expectations, because when they go to refinance this, what I don't want to happen is them being like, hold on a second, I have 134 grand left in this deal, and then they run the numbers. Let's say they plan to sell it in 5 years, and this again assumes no market downturn. It assumes a static, clean market. It doesn't talk about raised insurance rate. Like, none of that stuff is in this. And so when I ask questions, I kind of go, what is going on here? Because if they have to sell this before the 7.5 year mark, they lose money on the deal. So they spent all this time to lose money on the deal. So this is what this is me scrutinizing a deal. This is how you should be scrutinizing your deals. And if you want to see me go over this more, or even with your deal, you can submit them on our website, Private Money Quote, all one word, privatemoneyquote.com. We'll get terms back. We can do Zoom calls, whatever the case is. But I wanted to go over an example here because this, to me, raises a red flag. I'm not saying don't do it. Maybe this is a long-term 10, 15, 20-year deal. I don't know. We didn't get that far because when I started asking questions, maybe it turned off the investor. I don't know, whatever the case is. But you should be doing this underwriting. You should be understanding the money that's left, especially if you're doing the BRRRR method. You want to pull as much out. And if you can't, you also want, if your strategy is a 5-year hold and then you get rid of it, obviously you lose money. So don't do that. Underwrite your numbers. I'll talk to you in the next one.